for your love.
Hello everyone. Are you ready to dive into this world of financial models? So first, let's see what a financial model basically is. Financial models are powerful tools used to analyze and forecast the performance of businesses, investments, and financial strategies. They provide a structured framework for making informed decisions in an ever-changing economic landscape. In this video, we'll be covering DCF model, budget modeling, and option pricing model to just name a few. So now, let's get right into it and embark on this educational journey together. First, let's understand what a leveraged buyout is. It is a financial strategy where a company acquires another company using a significant amount of borrowed money. The goal is to generate returns by improving the acquired company's operations and eventually selling it at a profit. Leverage buyout modeling helps investors evaluate the financial viability of an LBO. So let's see a simplified breakdown of the process in just a few steps. So step 1. Gather the necessary information. This includes historical financial statements, projections, and other relevant data about the target company. Step 2. Analyze the historical financials. We examine the company's past performance, identifying trends, strengths, and weaknesses. Step 3. Make assumptions and build projections. Based on the historical analysis, we project future financials by assuming factors like revenue growth, expenses, and capital expenditure. Step 4. Determine the capital structure. We decide how much debt and equity will be used to finance the acquisition. Step 5. Create a debt schedule. We lay out the repayment plan for the borrowed funds, including interest and the principal payments. Step 6. Calculate the financial returns. We analyze metrics such as internal rate of return and return of investment to assess the potential profitability of the LBO. Step 7. Perform a sensitivity analysis. We test different scenarios and assess the impact of changing assumption to understand the investor's resilience. Step 8. Make an informed decision. After considering all the factors such as risk and potential synergies, we decide whether to proceed with the leveraged buyout. And there you have it. So it's a powerful tool that allows investors to assess the financial feasibility of an LBO. Remember, thorough analysis and decision making are the keys in its process.
DCF model is a method used to estimate the intrinsic value of an investment based on its expected future cash flows. Now, it is used in various financial and investment analysis to determine whether an investment, stock, bond, or a business is overvalued or undervalued. Now, coming on to the various steps to create a DCF model. The first one is to estimate the free cash flows of an organization. The free cash flows of an organization are available to both equity shareholders and debt holders after everything is paid for the continuance of the organization. We can understand it in the following manner. The more free cash flows of an organization has, the more attractive it becomes to the investors and the business holders. Because at the same time, the firm can pay the debts and also invest in new business opportunities. The second step comes out to be the calculation of WACC. Now, what is WACC? It's the weighted average cost of capital and is used to determine the cost of finance for an organization. The finance can come in both ways, whether it be debt or equity. Now, the third step comes out to be the calculation of terminal value. Now, what is terminal value? Terminal value is the value of an organization after the forecasted period. Now, it can be calculated in two ways, whether it be exit multiple method or perpetuity growth method. Now, in the fourth step, we discount the free cash flows and the terminal value to the present method. Now, in the last step, we calculate the implied share capital of the organization, where equity value is equal to the enterprise value minus debt plus cash. Once we have calculated the intrinsic value using the DCF model, we estimate whether the investment is overvalued or undervalued. If the intrinsic value is greater than the current market price, then the investment is undervalued and vice versa.
Moving on to a three-statement model, which is a way of linking the income statement, the balance sheet, and the cash flow statement of a company in one Excel spreadsheet. It allows us to see how the company's performance, assets, liabilities, and cash flows are related and how they change over time. The income statement shows the revenue, expenses, and profits of the company for a given period of time, usually a year. It tells us how much money the company makes or losses from its core operations. The balance sheet shows the assets, liabilities, and equity of a company at a specific point of time, usually at the end of the year. It tells us what the company owns and owes and how much it is worth. The balance sheet follows the accounting equation: asset equals to liabilities plus equity. The cash flow statement shows the sources and uses of cash for the company for a given period of time, usually a year. It tells us how much cash the company generates or consumes from its operating, investing, and financing activities. The three statement model links these three financial statements by using formulas and references in Excel, which is useful for financial analysis because it provides a comprehensive and consistent picture of the company's financial performance, position, and liquidity.
Consolidation means the process of finiting. So, as the name suggests, the consolidation model is constructed by combining the financial results of various businesses into one single model. It is similar to the sum of parts exercise, where division A and division B are added up to form a new consolidated model. So, now let us understand the process of constructing a consolidated model. Firstly, the FP&A analyst constructs different workbooks in Excel. Each project is assigned a separate workbook. Then the analysts identify various rows and columns based on the highest level to the lowest level for each of the project. Once the rows and columns have been identified, the FP&A analyst inputs various data that have been collected from the financial statements. Once this data has been entered, the FP&A analyst calculates various metrics which were not otherwise readily available from the financial statements. After completing the data tables, the analyst should always validate the data with the numbers found in the financial statements to ensure accuracy. Now, after all the individual analysis is done, the analyst should create a summary or a consolidated worksheet as the first tab in the module. Now, the numbers are added in the summary tables using formulas. Lastly, we clean up, format, and embellish the consolidated model to make it look professional for the management.
Before we delve into option pricing model, let's first establish what an option is. In finance, an option is a contract that gives the holder the right but not the obligation to buy or sell an underlying asset at a predetermined price within a specified time frame. Options are commonly traded on various financial instruments such as stocks, bonds, commodities, and currencies. Option pricing models are crucial because they help us determine the fair value of an option. The fair value, also known as the theoretical price, reflects the market's consensus on the option's worth. Option pricing model enable investors to make informed decisions about buying or selling options as well as managing their risk exposure. One of the most famous and widely used option pricing model is the Black-Scholes-Morton model, which considers various factors that influence option prices, that are the current price of the underlying asset, the strike price, the risk-free interest rate, and the volatility of the underlying asset's returns. By inputting these variables into the Black-Scholes-Morton formula, we can calculate the fair value of a European-style option. Apart from the Black-Scholes-Morton model, there are several alternative option pricing models, including the binomial option pricing model, the Heston model, to name just a few. Option pricing models are not only used by professional traders and financial institutions, but also play a vital role in the risk management and portfolio optimization. These models help investors determine the appropriate pricing of options and develop strategies that can maximize returns while minimizing the risk. Thank you for joining us on this informative journey. We hope that you found this video both educational and engaging. If you enjoyed this video, be sure to like, comment, and subscribe to our YouTube channel to stay updated with more such content. We appreciate your support and love hearing from you in the comment section down below. If you have any questions or suggestions for the future videos, please let us know. Remember to share this video with your friends and family who might find it useful. Thank you again for watching, and until next time, keep learning, exploring, and expanding your horizons. See you in the next video. I should fuck her in the Benz.